Welcome to the Ontario Mortgage and Real Estate Insights podcast, your trusted source for the latest developments, trends, and regulatory changes in the real estate and mortgage industry. I'm your host, Steve Hamowen, and in today's episode, we're diving into some pressing issues facing the Ontario housing market. Let's get started with a critical topic: Ontario's ambitious housing target and the challenges it faces. Ontario has recently scaled back its projections for new home construction over the coming years, casting doubts on the government's ability to achieve its ambitious goal of building 1.5 million homes by 2031. This year, the government initially expected to see 125,000 new homes constructed, but has now revised that number down to just 81,300, according to private sector forecasts presented in Ontario's Fall Economic Statement. Looking further ahead, the projections have been adjusted as well, with the strongest growth anticipated in 2027, when 95,300 new homes are expected to be built. Ontario's Finance Minister, Peter Bethlenfalvy, acknowledged the economic challenges impacting housing development. Yet he reaffirmed the government's commitment to reaching the overall target. He emphasized that high interest rates are a cyclical issue, but the government remains steadfast in implementing the infrastructure needed to facilitate more construction. However, skepticism from opposition leaders is palpable. Liberal leader Bonnie Crombie expressed her doubts, stating there is no conceivable way the government can achieve its housing goal. She pointed to the lack of incentives for developers and a concerning trend of construction workers leaving Ontario for more active markets in Alberta and British Columbia. "I think there was great hope and promise we would actually build housing," Crombie noted. "But developers aren't building homes, and construction workers are relocating to where the work is." Similarly, NDP leader Marit Stiles criticized the government's focus, highlighting that recent investments have gone towards projects like a potential tunnel under Highway 401 and new amenities at Ontario Place, rather than addressing housing needs. Stiles remarked, "This was supposed to be this government's biggest priority, yet I see them reversing course when it comes to tackling the housing affordability challenge." Despite the government's commitment of billions of dollars to encourage home construction, including $1.6 billion in new funding for water and wastewater infrastructure, municipalities have raised concerns about the metrics used to measure their performance in meeting housing targets. Currently, eligibility for Ontario's Building Faster Fund relies on the number of housing starts, but mayors of large cities have argued that construction delays are often due to factors beyond their control, such as high interest rates, supply chain issues, and labor shortages, rather than permit issuance. Municipalities have suggested that progress should be measured based on building permits issued, rather than housing starts. This adjustment, they argue, would provide a more accurate reflection of the efforts being made to meet housing demands. It's clear that while the Ontario government is pushing forward with its housing strategy, significant challenges and differing perspectives remain on how best to achieve these ambitious goals. After facing a barrage of interest rate hikes throughout 2022 and 2023, Canadians are slowly becoming accustomed to the recent trend of falling rates, although its likely impact on the housing and mortgage markets remains unclear. Inflation spiraled upwards, prompting the Bank of Canada to spike its benchmark rate by a total of 475 basis points over roughly 16 months, with fixed interest rates also surging. However, with inflation now firmly within the central bank's target range of 1 to 3%, it's embarked on a rate-cutting path that included an oversized 50 basis point reduction in its last announcement. This has sparked hopes that an uptick in home buying and refinancing activity could be in the cards. It's still too soon to say for sure that the housing market is in recovery mode, according to Manulife Bank CEO Katie Beauchart, although the move toward lower rates certainly helps. "I think there's a psychological impact of rates hitting a tipping point, and then some of the customers that have been sitting on the sidelines waiting for the rates to go down will then start to re-enter," she said. "But the question is, are we going to see that notionally getting into the 3% range for a good 5-year rate is the tipping point that then brings more people, and we really see the spike in demand?" Beauchart was speaking on a lender panel at the recent Mortgage Professionals Canada conference in Montreal, which took place from October 26th to 28th. She said the pace of recovery could depend on how firmly the Bank of Canada moves in bringing rates lower. I personally think it'll be a bit slower in terms of how it spurs demand, and then we have to see when we bottom out on that rate, she said. Fixed mortgage rates have slid substantially since May, with 5-year Government of Canada bond yields dipping amid a darkening economic outlook. Tracy Gomes, Scotiabank's Senior Vice President of Real Estate Secured Lending, questioned how much room remains for fixed rates to drop further. The market's already pricing in the Bank of Canada declining its own rate, she said. Still, a host of factors, including media attention on the rate cut and the likelihood of further moves to bring rates lower, are keeping interest in the housing market steady. I think there's still a lot of pent-up demand on the sidelines, Gomes said. And I think once they make that transition and go out to buy, we'll start to see some of that probably pick up quite a bit. While the popularity of variable rate mortgages plummeted in the face of the bank's aggressive rate hiking strategy in recent years, the recent cuts, which have slashed its trend-setting rate by 125 basis points, have seen variable options re-emerge as a viable option for many borrowers. Devin Adram, Vice President and National Director of Broker Services at TD Bank, said the lender had seen a marginal increase in variable mortgage originations over recent months. That's been noted across most channels, even though the proportion of variable rate mortgages is usually slightly more prominent in the broker space. The broker channels always had a significantly higher propensity to sell the variable rate over the fixed rate, Adram said. And that probably has to do a little bit more with the advice piece that I think brokers bring to the table in terms of how it is that you can use a variable to mitigate for either upside or downside risk, depending on what's happening in the market. And I think right now, we're seeing more deals being placed in the variable rate mortgage because there's this narrative that's been built up by the Bank of Canada where there's anticipated rate cuts. TD currently expects the overnight rate to fall to around 2.25% by the end of 2025, a possibility that borrowers are well aware of. If customers actually want to play that downward cycle, a variable rate is an excellent place for your customer for a little while now, at least until maybe it's time to put them into a fixed rate, Adram said. So we're seeing that profile go up slowly but surely, and becoming a more meaningful part of our mix. Justin Prasad of Blue Shore Financial highlighted that, despite lower rates, current high borrowing costs and economic uncertainty have slowed the market compared to early 2023. Nonetheless, borrowers are often inclined to simply opt for the lowest rate at any given time, a factor that could well come into play as rates drop on both the fixed and variable sides, according to First National's Chief Executive Officer and Director Jason Ellis. He recalled the trend seen during the COVID-19 pandemic, when borrowers gravitated overwhelmingly toward variable rates that were slightly lower than their fixed counterparts. I think back to that inflection point when 85% of our applications were coming through adjustable rates. You could get a 5-year fixed mortgage rate for about 1.90%, and the adjustable rate was 1.75%. Yet a big majority of the applications for the sake of those few basis points were coming in adjustable, he said. Don't forget that the next time we reach that inflection point, I find that there's a behavior amongst borrowers to choose the lowest payment in the moment, and that isn't always the right decision, so it'll be interesting to see how the dynamic changes. Another curveball set to be thrown into the mix when it comes to demand in the housing market. New rule changes arriving in mid-December, which will increase access to 30-year amortizations and increase the mortgage insurability cap. For Louis-François Poirier, Vice President of Retail Lending, Everyday Banking and Savings Products at Desjardins, offering those extended amortizations to first-time buyers and purchasers of new-build properties is a positive change that could nudge home buying sentiment higher. I think any government or policy change toward affordability is something that we're highly in favor of, he said. But he also highlighted potential unintended consequences from the move, not least the prospect of prices jumping as a result. One element that I'm curious about is if there's going to be a negative impact of pushing buyers toward buying something priced a little bit more than what they can afford, he said. So this is something I'm sensitive to, but what I'm a little bit more skeptical about is the impact on supply, which is supposed to be the first lever of this measure. In all honesty, I think any measure that increases demand without corresponding in an increase in supply will probably add lots of pressure on the prices. This one area that I'm skeptical about and will wait to see. But I think all in all, it's a very positive change. With benchmark home prices in Toronto and Vancouver exceeding $1 million, saving for a down payment has become an intimidating challenge for first-time buyers. Increasingly, parents are stepping in to help by gifting cash to their children. Natalie Gill, a senior financial planner at Royal Bank, has observed this trend growing over her 25 years in the field. "I've always seen parents and grandparents lend a hand in various ways," she said, "but now there's a heightened awareness and willingness to assist." Home prices surged during 2021 when mortgage rates were low, and although they eased as rates climbed, prices remained significantly above pre-pandemic levels. The Canadian Real Estate Association reported that the average home price in September was $669,730. While this is down from a peak of $815,723 in February 2022, it's still higher than the $517,731 average in December 2019. A report from CIBC earlier this year highlighted that relying on family funds has become commonplace among Canadian homebuyers. The report noted that 31% of first-time buyers received financial help from family, up from 20% in 2015, with the average gift increasing by 73% since 2019 to $115,000. Gifting money can benefit homebuyers in several ways. It can reduce the size of the mortgage needed, saving on interest costs, and potentially eliminate the need for mortgage loan insurance, which saves even more. In Canada, mortgage default insurance is necessary if a home is purchased with less than a 20% down payment. The premiums for this insurance decrease as the down payment approaches that 20% threshold. Joe Reed, Vice President of Wealth Management and Impact Investing at Vancity, emphasizes the importance of families having detailed financial discussions. "Even if mom and dad are helping with the down payment, the kids still need to be approved for the mortgage," he explained. Reed warns against scenarios where the buyer can make the down payment but can't afford the home in the long run. He advises working with a financial advisor to ensure that any gift is manageable for both parties involved. Moreover, gifting isn't just about the money. Lenders may require a gift letter confirming that the money is a gift, not a loan. If the gifter needs to sell investments to provide the cash, there could be tax implications, such as capital gains, if those investments have appreciated. Gill recommends that if a large sum is being gifted for a property purchase, it's wise to have a legal agreement to protect the asset in case of a relationship breakdown. Fairness and family harmony are also crucial factors, especially if the gifter has multiple children. This aspect should be considered in estate planning. If you're gifting to one child, what are your intentions for the others? Gill posed. Reed also noted that gifters should consider the differing financial situations of their children. If you're providing more support to one child during your lifetime, there might be an opportunity to equalize that in your estate planning, he suggested. Gill points out that parents don't need to provide a massive lump sum to help. They can assist their children by contributing to first home savings accounts or tax-free savings accounts, helping to grow their savings over time. You can do it gradually, with both you and your child contributing regularly, she said. As with anything, start with a small amount and make consistent contributions. Centum Financial Group has introduced a new compliance solution designed to assist mortgage brokerages in aligning with the latest regulations from the Financial Transactions and Reports Analysis Centre of Canada, or FINTRAC. These new rules, which came into effect on October 11th, demand increased vigilance in monitoring anti-money laundering and anti-terrorist financing activities. This heightens the pressure on brokerages to meticulously scrutinize transactions and report any suspicious behavior. One of the primary hurdles brokers face is the need to adapt to different systems while meeting deadlines across various platforms. Centum's newly launched FinTrack reporting form and dashboard addresses this challenge by being platform agnostic. This means brokers can utilize it across different mortgage origination systems, providing a seamless experience regardless of the platform they're on. The new compliance tool offers brokerage compliance officers a centralized view of all transactions, even if agents are working with different systems. When a borrower's credit report is accessed, agents are prompted to complete the necessary Know Your Customer and anti-money laundering forms, along with securely uploading any supporting documents. Automated reminders are also in place to help agents keep track of these compliance steps. Moreover, the tool integrates with direct pay, which simplifies the tracking and management of referral fees. This allows compliance officers to handle transactions and paperwork more efficiently, ensuring that everything is documented and in order. Centum assures that most brokers can have the system up and running within 1 to 2 weeks, making it a quick and efficient solution for compliance needs. The compliance tool is a part of Centum's broader suite of resources, which includes Report Hub and Mortgage Monitor. These tools are specifically developed to support brokerages in meeting the evolving compliance standards of today's market. Adrian Schultz, Centum's Executive Vice President, expressed excitement about supporting brokerages with what he describes as the industry's first platform-agnostic compliance tool. He emphasized that this solution allows brokerages to meet compliance requirements seamlessly across various origination platforms, while also supporting agents' independence in using their preferred tools. Let's turn our attention now to an important issue that's been making headlines in British Columbia and has implications for the real estate industry at large: money laundering. Darlene Hyde, the Chief Executive Officer of the British Columbia Real Estate Association, has recently highlighted the role that realtors can play in combating this problem. Money laundering has been a significant concern in sectors like casinos, luxury cars, and real estate in British Columbia. It's an issue that affects affordability for many residents and distorts local markets, all while enriching the criminal elements involved. We've all heard stories of criminals using bags of cash to buy luxury items, and real estate has been another area where this illicit money finds its way. However, Darlene Hyde emphasizes that realtors are not the ones handling cash transactions. Instead, they serve as intermediaries, connecting buyers and sellers. Realtors' work primarily revolves around matching the right buyer with the right home, similar to how a wedding planner manages the details of a wedding. Once a sales contract is signed and a deposit is paid, the transaction moves into the hands of other professionals, like mortgage brokers, notaries, lawyers, and banks. This doesn't absolve realtors of responsibility. As the first point of contact in a transaction, realtors are in a unique position to identify suspicious activities. According to Hyde, realtors are professionally obligated to report any suspicious behavior to FINTRAC, the federal agency responsible for detecting and preventing money laundering and terrorist financing. A month ago, the British Columbia Real Estate Association, in collaboration with other industry groups, issued a joint statement on anti-money laundering. This included best practices such as accepting only funds verified through financial institutions and enhancing education to help detect criminal intent. While realtors are not trained investigators, the association recognizes the need for them to contribute to the fight against money laundering. Hyde also called for improved information sharing between FINTRAC and other regulatory bodies like the British Columbia Securities Commission and the Financial Institutions Commission. A coordinated and efficient enforcement system is essential for tackling this issue. It's a problem that transcends any single province or organization, requiring smarter collaboration and continuous information sharing. Realtors, whose businesses thrive on reputation and relationships, have no interest in working with criminals. They're integral to the communities they serve, and a thriving community leads to a thriving real estate sector. Hyde asserts that realtors are committed to addressing this serious social and economic issue and urge all players in the sector to do the same. As we wrap up today's episode, it's clear that the fight against money laundering in real estate requires a collective effort. Realtors are stepping up to be part of the solution, and it's encouraging to see the industry taking proactive steps to safeguard the integrity of the market. Thank you for tuning in to the Ontario Mortgage and Real Estate Insights podcast. I'm Steve Hamilton, and we'll see you next time with more insights and updates from the world of real estate and mortgages. Take care.